My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Mr. Jay Mintzmyer, who a lot of you have seen given his prolific research when it comes to the maritime and shipping space. Jay, for those who are not familiar with your background, introduce yourself. Who are you? Why did you get interested in the shipping side of the economy? And what are you doing with your research currently?
Yeah, thanks, Michael. First of all, thank you so much for hosting this. I've really appreciated all the podcasts and the Twitter spaces you've been hosting over the last few months, actually the last couple of years. Very informative. Quick background on what we do. We run a buy-side boutique research platform. It's hosted on Seeking Alpha, but it's our own platform. They just handle the admin and that sort of thing. We've been involved in the shipping space exclusively now for going on 8 years in our platform, Value Investor's Edge. We focus on shipping because it's the perfect intersection between all these different global currents. And yet these stocks are all somewhere between maybe 200 million and 2 or 3 billion. So there's not as much competition from some of the bigger banks and bigger research shops. So there's a lot of dislocations that frequently come up. If we're ahead of the curve in terms of the supply and demand segments in shipping, we can usually exploit that in the market because there's not as much competition. Those of you who might just be getting familiar with shipping have probably noticed some of the stocks can be very volatile, and sometimes the trading patterns weekly or even monthly sometimes don't make any sense. They don't make sense to some of us either, but that's part of the beauty of shipping. Without those sort of disconnects, we wouldn't have the opportunity to exploit those as value investors. Our normal duration of holding is usually between 6 months and about 2 years. So we're not buy and hold forever type investors, but we're also not day traders. We're looking for those cycle swing advantages and exploiting those market disconnects before the market realizes what's going on.
Are shipping stocks usually low and steady? I mean, in the pre-COVID world, was it as volatile as it is now?
Well, almost nothing pre-COVID was as volatile as it is now. So shipping is definitely a little bit more, I guess you could say, exciting from a trade perspective over the last couple of years. But that said, shipping's always been kind of a high beta space. So even back in 2017, 18, 19, there was a lot of volatility and a lot of dislocations and opportunities to exploit that. So yeah, it's a little bit more volatile now, but that's kind of our ballpark and what we're used to.
All right, so let's talk about some of the nuances of what goes into the shipping space, so to speak. What types of companies within the subgroup are there? Which ones tend to be more interesting to you? Talk about just some of the differentiations here, because shipping is a very broad term.
Absolutely. Yeah, I think the biggest misnomer, and I should clarify up front, we do pretty much just maritime shipping. So we don't do like FedEx or UPS or XPO or stuff like that. I think the biggest misconception folks have about shipping is that it's all one big monolith and that it's all sort of, correlated to the GDP growth or global macro or whatever the Fed's doing or whatnot. It couldn't be more different from that. In fact, shipping is at least 6, if not more, subsegments, and each one has their own unique set of supply and demand fundamentals. So just real quickly, I'll hit the biggest ones, and folks are probably familiar with the broad categories. But we have tankers, which is both crude, just crude oil, regular oil, and also products, which is diesel, jet fuel, things like that. And then we have dry bulk, which is coal and grains and iron ore, stuff like that. We have the container ships, which of course have been very interesting for folks over the last couple of years with the supply chain dislocation. And then we have the gas trades, the LNG, liquefied natural gas, and LPG propane. Both of those have become a lot more interesting in the last few months due to the crisis in Ukraine after the Russian invasion.
All right, let's focus first on the container side, because that's where there's been quite a lot of concerns, right? Obviously, with the supply chain disruptions. I purposely named the space "supply chain disruptions aren't over," but maybe they are. Talk about some of the trends that you're seeing when it comes to container ships, and if some of these bottlenecks have been either resolved or close to being resolved.
Certainly. Well, the container ship sector has been the most interesting, I think, by far over the past couple of years. And that was due to an unprecedented surge in consumer demand on one front, primarily the United States, but also from Europe as a result of all the lockdowns and stimulus that was being pumped into the economy. Of course, consumers weren't able to spend their money on travel or going to restaurants or the bars, so they had a lot more money to buy stuff. Folks were spending more time at home and they wanted to upgrade their home offices and buy new furniture and remodel their kitchens and things like that. So on the demand side, we had an unprecedented surge. I've never seen anything like that before and might never see something like that again. Meanwhile, on the supply side, we had almost a decade of underinvestment in ships, in ports, in truck infrastructure, and all sorts of things. So it wasn't just the ships, it was 12 or 13 different bottlenecks across the entire supply chain. So those two things collided. And of course, anytime, and you know this better than anyone, Michael, anytime you have a commodity sector and you have such a huge mismatch between supply and demand, especially when things are more inelastic, you can see rates surge out of control. And that's what we saw. We saw shipping rates go up by tenfold, and we saw the ship lease rates, which is what the big leasing companies like Maersk and Costco and CMA CGM, we saw those lease rates go up by 7, 8, or 9x. The very interesting thing, Michael, that I do want to mention there is that those lease rates for ships were usually on contracts from 3, 4 to 5 years. I think there's a few that were even 6 years. So we're pretty much, I don't want to say at the end of it because there's still going to be bumps in the road. It's not over, but we're definitely like ninth inning towards the end of the road in terms of shipping rates. But what's just getting started is with these lease companies, they sign 3 to 5 year leases. And most of those leases have just started. They just started a few months ago. So those rolling earnings per share growth, free cash flow growth, that hasn't even been realized yet. And so we're going to see growing earnings, growing free cash flows, and all metrics improving on the owner side of the business for at least the next year, maybe year and a half.
All right, so that's actually an interesting point. So in other words, they locked in the higher rates. So even though, to your point, we're kind of in the ninth inning of all these dislocations in terms of the physical goods that are on these container ships, their earnings are going to be more driven on the peak fear that would still be problematic.
Yeah, that's right. So a company like Zim, and I know that's a really popular one, ZIM, that's exposed almost completely to spot shipping rates. So that's definitely sort of a ninth inning play, and you start to model out, well, what's it going to look like going forward? What are the cash flows going to do? And there's a lot of variability in those cash flows. But a company like Danaos Corp, DAC, which I'm long that company, or Global Ship Lease, GSL, I'm also long that company. Those companies are just getting started in terms of their earnings per share growth and things like that. And I think the market's kind of lumped them all together, but it's really two different sort of segments and a totally different earnings trajectory.
How many different companies are publicly listed when it comes to tankers in particular? If somebody wanted to track them explicitly to sort of get a sense of their expectations, not just around leases, but just in terms of overall activity, how big is the field?
So it depends if you sort out sort of the penny stocks or scam stocks or things like that. If you don't filter those out, then you have over 15 different companies to play with. On Value Investors Edge, we cover 44 companies. And there's about 15 companies in the shipping space that we don't even cover. I won't even talk about them. I won't even model them. I don't even like to mention their names. So, Michael, after we filter those out, we have 8 companies that we follow on the crude tanker space. And then we have 5 more that we cover on the product tanker space. So 13 total there.
Okay, so tankers is obviously that's been where there's been a lot of interest post COVID. I gotta imagine the dry bulk side gets to be more and more interesting just because of, you mentioned grains, iron ore. Talk about that space for a bit, how the war with Ukraine is maybe complicating some of those dynamics, and what's China's role when it comes to dry bulk from what you've seen?
Yeah, absolutely, Michael. And that's a good segue as well. And just for information, we cover 10 companies on the dry bulk space. The Ukraine war there is a lot more nuanced. With tankers, it's clearly bullish. I mean, everything that's happened as a result of the dislocations and the sanctions has been positive for rates. I got to be careful with, we're not celebrating that, but that's just the reality of the market. On the dry bulk side, it's a lot more nuanced. So the congestion that we've seen around the Black Sea and some of those Ukrainian ports does slow down good flow out of that area. So that little nuance is bullish. However, the grain exports that come out of those Russian ports and Ukrainian ports have been constrained. And so anytime you have an outright destruction of export volumes, that's going to be negative. The best scenario is when none of the actual volumes are blocked or eliminated, and yet there's congestion. So in Ukraine, it's been mostly negative and nuanced for dry bulk. China is by far the biggest driver in the dry bulk space. It's pretty much impossible to have a dry bulk bull market without a strong China demand surge. And where China really plays is in iron ore and in coal. And in coal markets, the Ukraine situation has led to sort of a global energy crisis or a crunch. It's more of a crunch right now in terms of the prices. But China has already ramped up a lot of domestic coal production. So even though the coal prices are surging and demand for coal shipments is strong, China has supplemented a lot of their imports via domestic production. So that's why the dry bulk rates right now are pretty weak. Another thing that's hurt the dry bulk sector is China's property sector. Of course, you know about Evergrande, and there's other property developers that are under a lot of stress. Some of that self-imposed by the Chinese government and some of their lending restrictions. Because of that slowness and toughness in the property sector, we've seen a slowdown in iron ore imports. And that is by far, iron ore imports are by far the biggest driver of Capesize rates. And Capesizes are the giant bulker ships. Those are the most volatile ones. The mid-sized ones do more coal and grains. And we've seen more of a stable situation in the mid-size. The rates are not great, but they're certainly not terrible. In fact, most of the owners of mid-size vessels are getting anywhere between 17,000 to about 19,000 per day. Cash break-evens for OPEX are around 8 or 9,000. So they're making 10 grand per day on their ships. So not a bad market. Capesizes, on the other hand, are barely above cash break-even at the moment, especially when you start thinking about debt service. And if you look forward on the forward curve for Capesizes, they're projected to go down significantly into early 23. So dry bulk is really in flux, Michael, and it's hard to get super excited about the macro setup. But what makes me interested from a value investor perspective is the setup of these company valuations. In terms of price to NAV, enterprise value setups, these are some of the lowest valuations we've seen ever in dry bulk. The supply side is fantastic. The order book is only about 6% of the segment, and it's impossible to get any new ships ordered before 2025. There's a lot of environmental regulations upcoming, which are going to start kicking into effect in just 3 months this January. And the balance sheets, on average, are the best they've ever been. Most of the companies we cover in dry bulk have debt to asset leverage of anywhere from about 10% to about 40% leverage. If you go back to the last cycle, which folks always ask, what happened in 2008, 2009, we had leverage at 60% or 70%. So totally different balance sheets, totally different supply setup, and very cheap valuations on all those stocks.
First of all, I had an Evergrande not that long ago at Starbucks, which is a really terrible joke. But hold on, given that sensitivity to China, I'm curious: could there be sort of the whites of the eyes of a regime change, or in terms of the way investors view China by looking at the behavior of those stocks? In other words, we all know about the constant lockdowns and the zero COVID policy, right? But if somebody's trying to say to themselves, now's the time to invest in China, could the movement of those stocks in particular maybe be an early tell that it might be worth considering that?
Well, I think that logic makes sense, Michael, but with the small market caps and the smaller size of these markets, these stock market caps relative to the overall market, I wouldn't read a ton into it. However, that said, if the world wakes up in a couple months and is suddenly bullish on Chinese growth and the Chinese economy, we would expect the dry bulk stocks to perform very, very well. And that's how they've sort of traded over the last few years. It's always been sort of a play on global macro and China growth. Now, I think the disconnect or the opportunity for value investors and those who have a little bit more patience is when you study the actual segment supply and demand, right? You get a little bit away from the big overall global macro perspective and you look more at the company specific fundamentals. And that's when you can see disconnects. And so whenever the global macro is really pessimistic or people are betting against China or don't want anything to do with it, that's usually when the opportunity, counterintuitively, that's when the opportunity strikes investors to start taking longer positions in some of these names.
All right, so that becomes interesting, right? Because everyone is concerned about, slowdown, recession in the U.S., but China is very distinct from the global macro, you can argue, to history. So there is, from what I'm hearing from you, a scenario where China could actually end up maybe reopening, doing well, and even though the U.S. continues to be in a recession, these stocks could, diverge just because they're more sensitive to China, which has already gone through a lot of economic pain.
Yeah, I think that makes sense. I'm a lot more focused on the Chinese economy and specifically the manufacturing segments and the property development segments and the infrastructure side, whether it's roads, bridges, airports, what be it. I'm a lot more focused on that than I am on any sort of like US consumer or EU consumer, anything like that. I mean, China is the main player here. There is an interesting parallel, and I'm not saying it would repeat again necessarily, but there is an interesting parallel in 2009 through 2011 where sort of the developed world was still stuck in a recession, very slowly reopening, and yet China was doing quite well. And the dry bulk rates from 2009 to 2011 were actually pretty good. They weren't, super cycle or anything, but they were very strong, very positive cash flows. And that was at a time, Michael, when the balance sheets of these companies were a wreck, to put it bluntly. The order book, the oncoming supply of dry bulk ships was massive. The order book was like 50% of the fleet at that time. This time around, the balance sheets are all extremely clean, and the order book is 6%, which is a modern history low. It's never been below 6% since going back to the 90s. And even then, it was like 5.5%, 6%. So we have the best order book arguably we've ever seen. We have the best balance sheets in the sector we've seen. We have near record levels of low valuations and discounts. And oh, by the way, we have a huge influx of environmental regulations upcoming. So the setup is really good, Michael, but we do need, China falls on its face. The dry bulk stocks aren't going to do that well. We do need a little bit of help from the demand side.
Yeah, no, that makes sense. Okay, so we covered dry bulk, we covered container ships. Let's talk about the tanker side here, because you alluded to it. We obviously are still in this energy crisis. First of all, talk about the importance. I know that sounds like a silly question, but talk about the importance of tankers in how that movement plays into what's going on in Europe in particular, and what are some of the valuations look like there? Because I have to assume that there's probably been quite a strong correlation of tanker valuations to oil price movement, but maybe I'm wrong.
Yeah, Michael. Well, first of all, the tanker situation in 2022 has been a game of dislocations. There hasn't been a significant influx in overall oil exports or oil growth or global demand growth in oil, anything like that. But if you look at the tanker rates over the last year, they've surged. It was led by the product tanker market, which started to take off right after Ukraine. And then the crude tanker market sort of picked up the football around June into July. So the tanker market is very strong right now, but it's all based on shifting trade flows and dislocations and inefficiencies, things like that. So for example, just one example of that is the US, of course, has been doing the sales from the SPR, from the Strategic Petroleum Reserve. And so far, those are supposed to go through mid-November. There's been some political, signaling that those might be extended. But what's happening there is the US is dumping domestic supplies into the market, and those oil barrels are being exported. And so that is driving up demand for new trade routes, longer distance trade routes that weren't quite as prevalent a year or two ago. So that's one example where just a shift in trade flows, the total global volumes might not necessarily change that much. The total global demand might not change that much, but just that shift in trade flows between the US dumping the SPR has had a very positive impact on crude tanker rates.
So I'm not a huge believer in the onshoring, friendshoring narrative, maybe more onshoring than friendshoring, but talk about how some of these broader trends, or at least narratives around onshoring, impact the shipping space, right? Because if you have more and more things being manufactured, made in the US, presumably there's going to be less activity, right, in terms of the shipment of those products from various exporting countries.
Yes, certainly. And that's something to keep a close watch on, especially for the container ship sector, the finished goods and those sort of transports. As far as the raw commodities, if we're talking tankers for oil or product tankers, diesel, jet fuel, things like that, or if we're talking about dry bulk, iron ore, coal, grains, things like that, you can't just quickly change or near shore or onshore, or whatever you want to call it, the raw commodities themselves. So those trades are going to be a little bit less impacted. Like I mentioned earlier, Chinese import demand is going to be the main driver, regardless of any sort of onshoring or whatever you want to call it. For container ships, it's certainly something to watch. However, I think a lot of folks in the market really underestimate a couple things. First of all, they underestimate the significant cost spreads between manufacturing something in Asia and manufacturing it domestically. The cost spreads are enormous. Just to use an example of tennis shoes, if you think about like Nike shoes or something like that, in a normalized shipping environment, it costs about 50 cents to move a pair of shoes from Asia to the United States. Even during that tenfold increase, we're talking about $5 a shoe, right, to move a pair of shoes from China to the US. And that was at the all-time record highs in shipping. But the actual production cost, right, if you set up a Nike factory in the United States versus one in Vietnam, just using a random Asian country there, could be $10 a pair of shoes, right? So it's an order of magnitude less efficient. So that's one thing I think folks aren't quite appreciative enough about is how efficient some of these systems are once they normalize. The second part is how long it takes to build a new factory, to secure enough labor. If you're talking about nearshoring, like moving to Mexico, you have to worry about the geopolitical risks. You have to worry about if there's enough population that's qualified to work and the stability of that and so forth. So these are 10-year, 15-year, 20-year processes. And the shift in jobs from the United States manufacturing jobs to Asia did not happen overnight. This was a 20-25 year phenomenon. And so folks want to talk about onshoring or nearshoring or whatever that is. Deglobalization is something I hear a lot, which is kind of interesting. That's a 10-year, 20-year sort of thing. It's not something that happens overnight. It's super expensive. It takes a really long period of time. What is happening, Michael, and I think is a much bigger impact to shipping, is folks realize that we can't depend upon a single country or a single trade flow or a single source for critical goods or critical markets. So what we're seeing is a lot more redundancies. We're seeing a buildup in strategic inventories of certain items. And those redundancies and those supply chain duplications are actually going to make shipping a little bit less efficient. It's actually going to lead to a demand increase in shipping, because if you diversify your trade partners, now you have two trade routes instead of one. And the most efficient route that everyone was used to servicing is now split into two or three different routes. That could actually lead to a demand increase just by the nature of rerouting ships and all that sort of stuff.
Yeah, no, that I can buy. As you were talking, that's exactly where my mind was headed, right? Because again, I'm skeptical. It's like companies still want to have higher margins. They still want to squeeze more money and have less costs. So yes, we can talk about deglobalization from here to tomorrow, but greed will probably counter that, right? But you do, to your point, still need to have the backups in place in the event that one of these disruptions happens. So the truth is somewhere in between, but that point about conceivably, if you have more diversification of locations that your goods are manufactured from, yeah, that should result in more routes, more shipping activity, and perhaps I would presume then on the ship side, smaller ships but more of them from the container perspective.
Yeah, I think there's a lot of shifting dynamics. And just one footnote I want to make, and you might already know this, Michael, but just for some of the listeners, is 91% of the global trade moves on the water. And so rail plus trucks plus airplanes is only like 9 to 10% of the global trade. And so I get a lot of questions of like, oh, well, why won't these companies just shift to air freight? Or why won't they just use rail? Well, air freight's like 1% of the global market, and rail is like 5 or 6%. So ocean shipping has such a larger market share of what's already moved around. And ocean shipping, especially as we start thinking about ESG movements, as we start thinking about decarbonization and climate change and all those sorts of things, shipping is far, far more efficient, not just from a cost perspective, but also from an emissions perspective. So there can be trade routes, for example, moving a box of goods, a 40-foot box of goods from Shanghai, say from there to Chicago, might actually have less emissions than moving something from Mexico, right, to Chicago. Because of course, Mexico to Chicago would all be truck or partly rail, partly truck. Whereas that distance from China to Chicago, it might be, 4 times the miles, but a big chunk of that is done via the ocean, right? Moving from Shanghai to say Seattle, Tacoma or LA, Long Beach. And that part of the voyage is just so much more efficient, and not just in dollars, but also in emissions.
Talk about industry concentration for a bit here, right? Because you mentioned there's a select number of stocks that you screen and filter for, and you mentioned the market cap of 200 million to couple billion or so. What are some of the trends in terms of consolidation, in terms of who or which companies rather sort of are the primary drivers of activity? Talk about that dynamic for a bit.
So the biggest consolidation trend that we've seen is not even particular in the companies we follow. Most of the dry bulk and tanker firms, even the large ones, only have maybe 2%, 3% of the global capacity under their specific control. So there's a lot of room to go. In fact, in terms of consolidation, we're barely getting started on that front. There's a huge tanker merger ongoing between a company called Euronav, EURN, and Frontline, FRO. And I should disclose I have a long exposure to Frontline. That's the biggest tanker merger we've seen in 15 years, closest to the biggest merger we've ever seen in tankers. And that's still just a tiny piece of the market. We're just getting started. The main consolidation trend that has already happened is in the container liners. So the main shipping companies like the Maersk, CMA, CGM, Costco, things like that. If we go back to the mid 2000s, say 2007, the fragmentation of the liner business, the top 10 only controlled about 40% of the market. Now the top 10 control over 80, about 85% of the market. So there's been a huge consolidation. The top 5 control around over 60% of the market. So there's been a huge consolidation in container liners, and that means they can rationalize their capacity a little bit more. They can cancel sailings, it's called blank sailings when they need to. It's very similar to what happened in global airlines. Remember, global airlines were just a horrible, horrible business for 20, 30 years. I mean, Warren Buffett had quotes about them and what a horrible place it was to invest your capital. But if you look at companies like Delta and American Airlines and United, over the last 10 to 15 years, they've been done pretty damn well. And that's because of all the consolidation and their adaptations to regulations. And a very, very similar trend is happening in global liners. It just took them about 10 years longer than it did for the airlines.
Yeah, no, that makes sense, and I'm going to assume it's that size and concentration, which is their equivalent, quote unquote, moat, right? Because it's harder to be a new entrant when presumably there's a lot of expense to get these things up and running relative to those who have been operating for many, many, many years.
Yeah, absolutely. I mean, you have a market leader like MSC or Maersk are the two largest container ship companies, and their current fleet alone, just those two companies alone, is 34% of the market. And if you include their new builds, the order books that's going to come on in the next 2 years, those two companies alone are going to control 40% of the global market in just two players' hands. And so, yeah, you cannot come out there with a startup and compete in any sort of reasonable way. I mentioned Zim earlier, and Zim's kind of been a popular one, kind of a hot stock. Look, Zim controls 2% of the current global market. So Zim is just kind of into the whip, right? They've done fantastic because they've had high operating leverage, but that's a 2% player. And we're talking about two companies alone that are going to control more than 40%.
So you mentioned sentiment. Sentiment's an interesting term because while there's some ways you can measure and quantify sentiment, there's plenty of ways to just not say it or not to quantify it just based on feeling. I shared the nest here, Jay, that tweet you put out at the beginning of the month. Shipping sentiment is horrendous. At the last peak, our free trial campaign had 150 signups, and now it's pretty much nothing. So you're kind of using your own anecdotal way of looking at demand for your own service around as a tell on sentiment. But are there other things other than obviously price action that tell you that there really is sort of a feeling that this is not an area to touch for those that want to be contrarian? Because sentiment on an industry or a sector is very different than arguing sector against the broader market.
Right. No, of course, Michael. The easiest way for someone to gauge sentiment in shipping stocks, whether it's across the sector or segment specific, is just to pull up a chart and do some basic technical analysis on it. I'm not a big TA guy myself, but if someone's simply looking for sort of momentum and sentiment, it's not real difficult to pull up a chart of, say, Zim or DAC, Danaos, or GSL, Global Ship Lease, and see the horrendous negative momentum in those stocks. You could do the inverse for tankers, right? Like I said, shipping is not always a monolith. Tankers have had pretty great momentum from April and May through the last few weeks. So that's just the kind of the surface level. In terms of fundamentally understanding where things are at, there's multiple ways to sort of skin this cat, but the one we use the most is price to net asset value. Of course, NAV, or net asset value, is just the price of the ships minus the debt that company has. So that's step one. Step one is looking at what those ratios are at. And in container ships, it's all-time record lows. It's never been cheaper than it is today. In dry bulk, we're not all-time record lows, but we're pretty close. Then step two, what you have to do is you have to look at the underlying asset prices. Say, okay, if I buy the stock, I'm getting a discount to these ships, but where do these ships sit in terms of normalized averages? And for container ships, the charter free values are well above historical averages. So you can say, okay, maybe that discount's not as big as it seems at first. In dry bulk, they're only a little bit above the median and normalized values. And then the third thing, sort of addendum to that, is you can look at the new build sort of replacement cost. And of course, with rising inflation and the demand for things like container ships and LNG ships, the price to build a new dry bulk vessel today, or the price to build a new tanker ship today, is the highest it's been since 2007, 2008. So if you look at the replacement cost value, it's even higher than the current NAV. Oh, and by the way, if you buy the stock, you're getting a huge discount on top of that. So that's sort of the fundamental approach that I use to say that things are cheap or sentiment is poor. In terms of technical analysis, anybody can pull up a chart and kind of do that for themselves.
I'm actually, maybe I shouldn't be surprised, but I am surprised that you don't necessarily use technicals as part of your research process. And technicals are often what cause people to sell, right? I mean, a lot of people I've seen tend to buy based on fundamentals in a story, but they tend to sell primarily based on a chart. If you're not looking at technicals in terms of when to sell, what would be a trigger for you to reevaluate, to say to yourself, okay, well, maybe this is not the investment that I hoped it would be? What causes you to change your opinion on a particular stock in the space?
Yeah, well, first I would caveat. It's not that I don't, care at all about the technicals or look at all about them. I'm just not a chart technician in any sort of way. But anytime someone tells me, if I have a stock I really like the fundamental setup, and someone says, "Oh, that chart's nasty," or "Oh, that chart's terrible," I'm like, "Ah, okay." Like, I'm like, this is helping me out here. I like that. Anytime someone says, "Oh my God, Jay, the chart's beautiful," I start fumbling around looking for my liquidate all button. I mean, shipping, if you do shipping with technicals, that's just a recipe to get bent over in this market. I'm not saying they don't work ever. I'm sure they might work for a day trader or someone who goes week to week. But if you're making your investment decisions in shipping based on technical analysis, I mean, maybe maybe there's some people that do it effectively, but usually in shipping, you want to buy the nastiest, grossest charts possible. And anytime everyone's circle jerking about great technicals, it's time to get out.
And is that just because they tend to be more volatile on average, adjusted for their market cap, right? Because that volatility is often what throws off technicals.
I think technicals in shipping, it's a little bit heavier on the retail side and it's a little bit heavier on the short term hedge fund side of the business, sort of the marginal buyers and sellers and traders, if you will. So technicals just reflect, right, the underlying buying interest and buying power and momentum and sentiment. So anytime something is really heated and hot in shipping, it's usually not because it's a great value. It's usually because it's the market loves it, right? It's sort of like the hot stock of the day. And for someone like myself who's doing 6 to 24 month periods of time, the hot stock of the day is the one where, hopefully I bought it 6 months ago, if I got lucky. But the hot stock of the day is not something I want to be jumping on and piggybacking. Unless we're talking like a week or 2 weeks or something like that. Now, if we're talking like front month call options, then yeah, it might be nice to be in a stock that's kind of hot. Like Zim was hot last year, right? But in terms of investments, if everybody's already talking about it, it's too late. That's not our edge. Our edge is being there 6 months or 12 months before people are talking about it.
Please make sure you follow Jay Mintzmyer and obviously check out his research available on Seeking Alpha, a real specialist, obviously, in the space. And again, my name is Michael Guyad. Okay, so it's interesting to me that we're talking about this. I am curious, Jay, as far as what exactly is the methodology that you're using besides valuation to determine this is a better opportunity than something else? Meaning, are you actually talking to CEOs at these different companies? Are you physically going to check out, various tankers? Yeah, I'm sure you've done some of this in your career, but talk about some of the analysis that you do that maybe others don't.
Certainly. In terms of management, we know almost all the management teams on a first name basis just by virtue of being involved in the sector for so long. And we definitely listen to them and listen to what they have to say. But shipping management teams are eternal optimists. So they always got something positive to say. So it's not necessarily like we'd have a call with management and then get super bullish. If anything, the more bullish they get, the more nervous we would get on our side. We have a team at Value Investors Edge. I'm just the guy that goes on and tweets and talks, but we have several folks who support our research. One of them I want to give a shout out to is James Catlin, and he does our shipping macro research. And when I say macro, it's not necessarily a systemic macro, like, what the Fed policy is going to be. It's more of like, what does the demand segment for crude tankers look like? How are the trade flows developing? So it's almost like a micro macro hybrid, if you will, or mini macro, I guess you could say. And so James's research is very instrumental into identifying which segments are heating up or, which segments have huge headwinds ahead. And then we have another gentleman who works with us. His name's Clement Mullins, and he's done fantastic work on the modeling and company specifics. And then Michael Boyd is another person I want to mention who helps us out with energy infrastructure. So that's sort of the team approach in determining what's going on in the bigger sphere of things. It's not just like we don't just look at a screener and say, oh, this has like a discount to, this is a cheap price to earnings, or, oh, this has a big, price to NAV discount. There's got to be a little bit more involvement than that. And you're right, Michael. Part of it is knowing the management teams and knowing which ones are trustworthy and knowing which firms have good capital allocation policies. A lot of the money in shipping is made from knowing, when to buy and sell ships around the cycles. And the companies that are willing to return capital to shareholders, whether that's repurchases at a discount or dividends when earnings are strong, those companies over time are almost always going to outperform the companies that don't value capital allocation. So in terms of management, it's all about capital allocation and market understanding, not necessarily right whether or not they're bearish or bullish or whatever. Yeah, that's a great question. It's always good to hear from you. And that's absolutely true. I mean, the prices of the underlying assets are correlated to steel, number one. And then, of course, just the demand for new ships, right? If all the ship owners are out there trying to order ships at the same time, just supply and demand of a commodity product, right? The prices of ships are going to rise. So it really gets us excited. I guess the holy trinity or trifecta where everything lines up. And that holy trinity or trifecta would be part one would be promising or optimistic macro picture. And when I say macro picture, I don't mean, again, like the Fed's doing or whatever. That's systemic. That's not something we spend a whole lot of time scrolling about. What we're looking at is the upcoming demand for that shipping segment, the trade flows and whatnot. So that we want that to be promising, at least. The second thing would be a discount to NAV of the stocks, right? They're trading at a discount. So you can buy stocks cheaper than you can buy real assets. But if the real assets are cheaper, then the correct play would be private equity or direct investment. And then the third part of that trinity triangle, whatever you want to call it, would be that the assets themselves are valued below replacement cost or valued below historical normalized values. And that sort of trifecta, holy trinity, I mean, I'm going to blaspheme here or something, but that's what happened with container ships. I mean, it was the perfect setup between those three things. They all came together at the same time back in 2000, fall 2020. And container ships were not popular back then. I mean, everyone thought, nobody was really excited about those. Nobody was really talking about those until summer of 2021. So it took a while. Most recently, the sector that exhibits those three things has really been product tankers and in crude tankers to a lesser extent. The longer term macro setup is not quite as, it depends on a lot of dislocations like we're seeing with Ukraine. However, we had big price to NAV discounts coming into this year, and a lot of the assets were far below replacement valuations. So that was another sort of sector that started to check off those boxes for us.
How does volatility from policies changes at the executive level impact how these companies operate? So today, right, I think it was announced that Biden's thinking about banning Russian aluminum, right? Do these shipping companies, do these management companies, are they in talks with various political leaders, with the administration to maybe prepare for new policies that are coming down the pipeline that would directly impact their shipping, their routes?
I mean, they should be in a world where everything functioned efficiently. You would think the Department of Commerce and Department of State would have a roundtable call with experts from the tanker sector, bulker sector, and all these shipping sectors. That's how you'd hope it would happen. Unfortunately, it really doesn't seem to work that way. If anything, shipping companies are viewed in an antagonistic light. I mean, the whole time during the supply chain crisis, almost all the blame was laid at these big liner companies, when in fact, the crux of the blame was mostly US-based logistical bottlenecks, which came from a decade of underinvestment in poorly positioned ports and labor union strife and things like that, COVID policies. They didn't have a lot to do with the liner companies, but politicians, politics and all that sort of thing. In terms of the impact on the markets, generally speaking, most sanctions, especially like the one-off ones like banning Russian coal earlier this year, talks about aluminum, the Iran sanctions we've had. Generally speaking, most of those sanctions are bullish for shipping because it makes the markets and routes less efficient. And now it's not true for everything, but generally speaking, most of those sanctions are pretty bullish for shipping rates. The one exception to that, and I would say the one sort of nuclear option that would be bearish for shipping, is if the U.S. returned to some sort of crude oil ban, or especially if it was some sort of product export ban. It's been tossed around politically. I don't think it's very likely to happen. I would say if I was handicapping it, I'd say 25-30% chance of it happening, some sort of limited time ban. But if the U.S. banned oil exports, especially or product exports like diesel or refined gasoline, anything like that, that would be very, very bearish for the tanker market, because the U.S. exports of either crude oil or products are a very long haul. Right? If you think about exports out of Houston, Texas, whether you're sending those to China, even if you're sending those to Europe, that's still a pretty long distance. If the U.S. would block those exports, OPEC would have to ramp up their exports. And of course, the distance from the Middle East Gulf to China, Middle East Gulf to India is a fraction of the distance of the United States to China. So that would be the one case where we're kind of watching that one. And that would be very bad for tankers if that happened.
Okay, so everybody, because the availability heuristic, will probably immediately think about how tankers and how the shipping space reacted in the midst of the COVID lockdown, but that's probably not the right map to look at. Talk about some parallels to other major recessions, in particular 2008 and that downturn. What's similar, what's different in terms of fundamentals, the economy, everything?
Yeah, so I think that's a great question. Yeah, the COVID turndown was so weird because it was so great for shipping, and yet all the shipping stocks got demolished. And that's why we had the best buying opportunity we've had in our careers and probably in my lifetime. Probably never see something like that again. But in terms of parallels to 2008 and 2009, well, first of all, in 2008, 2009, summer of 2008, most people in shipping were super, super bullish. I mean, I know in the housing market and the credit markets, there was sign of distress, but in the shipping markets, people were head over heels bullish. The order book was the largest we'd ever seen. The balance sheets were terribly over leveraged. The valuations on these companies, we were talking like 10 times normalized earnings. We're talking about 150% price to NAV. We're talking about huge valuations on these companies. And so what happened afterwards is you had a crash, right, in the global economy. Dry bulk was okay, but the rest of the segments did terribly. Container ships did terribly, tankers did terribly. And at the same time, you had this huge glut of supply that came onto the market. Oh, and by the way, these balance sheets are all terrible. And this 50, 60% leverage was based on inflated asset values. So you had companies with like reported book values that were just totally artificial, right? Because the book value is just an accounting value. So you had these companies that would have like $20, they traded $1, they'd have $20 of book value and they'd go bankrupt. And people are like, how's a $20 book value go bankrupt? Well, it's because the book value is BS, right? It's an accounting value. So that's what happened in 2008, 2009. So if you look back at shipping stocks back then, you see everything get crushed. You have to understand that context. And then over the next few years, from anywhere from 2009 to about 2016, the market was suffering. It was a 7-year, 8-year glut of all that new supply that had been ordered during the heyday. It just came on and glutted out the market for the next 6 or 7 years. So when you look back at shipping returns, you look back at what happened over the last cycle, that's important color to remember. This time around, especially in dry bulk, but also in tankers, the order book is nothing to speak of. 6%, 7% order book. The balance sheets are all very strong. Oh, and the valuations, the sentiment is all pretty terrible. If this turns out to be a massive global recession, and I'm not saying it won't be. There's far smarter people than I that can debate that, and you're probably one of them, Michael. But if we end up having a recession here, this is going to be the most forecasted and most obvious and most expected recession in history. I mean, like people have been calling this recession for like a year and a half now. That's a totally different setup than we had in 2008. And I know in hindsight, people are like, well, the big short guy, Burry, was calling it and other people saw it. But the sentiment we saw in the sector and the valuations we saw in 2007, 2008 were far, far different than what we have today.
No, I think that's actually an important distinction, right? Because it's like at some point, bad news is priced in as long as it doesn't get worse, meaning an event. I mean, one of the things which is beyond bizarre about just market movement, as I keep noting, is the path behavior is unlike anything we've really seen in equities going back to 1931, and something we've never seen with treasuries going back to 1961. So it's like it's this prolonged sort of sequence which has been anticipating something really ugly. And in the event that the ugly does not happen, as ugly as people think, that would argue very much for a return of fundamentals mattering and these stocks going higher because if you're making the argument that now's the time to consider buying or allocating more to the space because in 6 to 12 months they'll be performing better, presumably that means the economy is not doing as poorly as people think.
Yeah, well, I think there's also a huge disconnect between where shipping stocks trade and valuations trade. But I think there's a big disconnect between how these stocks are priced and how they're performing and how their balance sheets are situated versus, say, the S&P 500 writ large. Right? If you look at the S&P 500 valuations, and I'm not arguing directionally right, on the S&P 500, that's far, far above my pay grade. My only point here is if you look at the valuations of the S&P 500, those are above long-term normalized average valuations, right? And a lot of folks have said the S&P is pricing in sort of, they call it a Goldilocks, right? Between where the Fed can control inflation without destroying the economy. But the S&P is priced, it's priced a little bit more optimistically and above averages. And yet you have the shipping sector, which is priced at near all-time record lows. So there's a dislocation just between that market alone, right, regardless of what happens systemically. Well, first of all, I got to congratulate you on being there a year ago. So fantastic foresight, having that ability to be positioned there, very well done. To your point on inflation, I think it does align with something I mentioned recently. It might not be a popular comment, but people were debating, next year's inflation level. And again, that's kind of above my pay grade. But I tell folks, I'm not afraid of 5% inflation, 6%, even 10% inflation. What scares the shit out of me is negative 1%. Right? My environment, inflation, Fed's going to tighten things up. I'm already in the best valued stocks that are going to profit from this sort of commodity surge. So I'm not as worried about, I don't want 10%, but I'm not worried about 5 or 6 or 7% inflation at all.
What's interesting about that, and this I think where it gets to be interesting in terms of time frames, right? They don't know what they're doing because they're just reacting off of short time frames, and there's no such thing as a longer term trend to do the right thing, right? So, and Jay, I'm curious actually from your perspective on this too, because I do my own premium research, the Lead Lag Report, also hosted on Seeking Alpha, and then parallel on leadlagreport.com. I'm sure you see the same dynamic that I do, which is that if what you are saying isn't working in the small sample, people say, you know what, I'm going to unsubscribe to this research. And then they come back when there's hot performance again. Right. So there's this. My point is that this time frame aspect, which is what makes investors poor investors, is the same dynamic that also happens with policymakers.
Yeah, absolutely. No, yeah, Michael, that's a good point. And then I also think there's a lot of recency bias in just what's happened the last couple months, or what's been hot, what's been popular stocks on Twitter or whatnot. Just one example of that. I mean, I think the sentiment in shipping right now is pretty poor from what I've noted. I have definitely noticed a lot more pushback on Twitter and other forums, and pushback's good, right? We need more of that. But even in like our own chat rooms and stuff, there's a lower level of sentiment. I mentioned the other day that we had a free trial open for the weekend, and we had like half a dozen signups. Back in April, we had like 140 sign up in one day. And the funny thing is, our model portfolios, which are long only, right? No options, no leverage, just long stocks. They're up an average of 41% year to date, and the S&P 500 is down 25. So that's 66% outperformance. I mean, it's our second strongest year in our careers. And yet the sentiment couldn't be more worse. And I think a lot of that is just the stagnation and poor returns just over the summer, right? And folks are losing sight of like the longer term trends and the longer term outperformance.
Aside from subscribing to your research, Jay, obviously, how else do you recommend people learn more about the space? Because obviously it's important for the way the global economy functions, right? But it's not something that often gets a lot of coverage in traditional media.
Yeah, I'm glad you asked, Michael. There's a lot of free resources out there for folks to learn a little bit more. On Seeking Alpha, you can go there right now. You can follow me there. I have some free articles. James Catlin is our macro guy, and he writes a lot of fantastic macro reports. He shares, I think, about one a month. He actually shares publicly, or one every couple months. Those are good resources. Slash 24/7 is a shipping news site that is totally free. So folks can get on there and learn stuff without needing to pay any money. There's a book called Maritime Economics by Martin Stofford. If you're really trying to get more into the sector and be an investor, or start learning more about these stocks, that is the Bible of shipping investing. And it's just a handful of resources, but those are all free.
And of course, everybody make sure you follow Jay Mintzmyer. I'm going to try and again have this as an edited podcast very soon under Lead Lag Live on Spotify, Apple Podcasts, all that good stuff. Make sure you follow Jay. Appreciate everybody spending the time here. Thank everybody for joining. Thank you, Jay. Really appreciate your time. Everybody enjoy the rest of your day.